Everyone is talking about an AI market crash and the sentiment is at extreme fear. What if I told you the exact same questions people are asking today about AI were asked in the year 2000? Back then, the Nasdaq fell over 80%. Fortunes evaporated overnight, and everyone was convinced the internet bubble meant tech was dead forever. People in my school community are in full-on panic mode. Is AI the new dot-com bubble? Should I sell everything? Is this the top? Using all of my 24 years investing experience, I'm going to walk you through what really happened in 2000, what's happening now, and how to invest calmly in any market condition. Section 1, 2000 versus 2025. Are we reliving the same bubble? The dot-com bubble didn't just pop, it exploded. From 2000 to 2002, the Nasdaq fell 83% and took 15 years to recover its previous high. Why? Because companies weren't valued on reality. They were valued on dreams and potential. No profits, no revenue, just hope. To me, it sounds like many AI companies today. Well, maybe, because this time there are real differences. We'll get to those in a minute. But first, I'll give you 3 timeless lessons from the dot-com crash that still matter now. Before we get to that, I want to tell you how I offer one-to-one investing support because people are genuinely worried. You can join my investing community on School, where you get around hundreds of other like-minded investors. You can ask me anything, and we can even jump on a call. If that sounds good, the link is below in the description. Section 2, the 3 lessons that would have saved investors in 2000 and will likely save you today. Lesson 1, focus on fundamentals. In the 2000 bubble, companies had hype but no business model. Today, the big AI names, OpenAI, Anthropic, etc. actually have real revenue. But here's the thing, even brilliant companies can be terrible investments if you pay the wrong price. Stick to companies with cash flow, earnings, and competitive advantage, not dreams. Lesson 2, avoid herd mentality. During the dot-com bubble, tech became nearly 40% of the US stock market. Everyone crowded into the same trade. Then the bubble burst and they all ran for the exit at the same time. Today, Mag 7 stocks make up a third of the entire S&P 500. History doesn't repeat, but it rhymes loudly. When everyone is leaning one way, you go the other way, the other direction. Basically, go against the herd. When sentiment is this low, it's usually a good buying opportunity. If this type of info, by the way, resonates, hit subscribe so we can build wealth together. Lesson 3, patience wins more than timing. People like David Bowie back in the day said the internet would reshape society in ways we couldn't even imagine. He was right, but it took decades. AI is the same. This will not be a 3-month transformation, and to be honest, I'm personally glad. It's a multi-decade structural shift. Your takeaway, you don't need to nail the top or bottom. You just need to stay invested long term, long enough to benefit from long-term innovation. Section 3, who actually made money during the dot-com crash. This is the part nobody really talks about. While tech collapsed, 5 groups quietly done really well. 1, value stocks. When growth got obliterated, value outperformed massively. Investors who rotated early dodged the bullet, the carnage. 2, defensive sectors. Consumer staples, healthcare, utilities. People always need toothpaste, food, medicine, etc. 3, gold from $250 to $1,900 an ounce over the following decade. Real assets shined when tech suffered. 4, international markets. The crash was mostly a US tech problem. Europe and Asia held up really well, much better. This is one of the reasons I like global diversification. When I invest into a low-cost index fund. 5, bonds. When fear rises, money runs to safety. Longer duration treasuries skyrocketed. These patterns repeat across history. As always, nothing in this video should be taken as financial advice, and the full disclaimer can be found below in the description. Section 4. So, will AI crash like the dot-com did? Here's where it gets interesting. There are similarities, high valuations, massive concentration, narrative-driven investing, but there are key differences. Difference 1, stronger fundamentals. The Mag 7 generate a quarter of all S&P 500 earnings. Nvidia alone has 62% operating margins, unheard of for a company that size. This is not pets.com that went tits up back in the dot-com bubble. Difference 2, cash-rich balance sheet. AI leaders are sitting on enormous cash piles, not burning cash like in the 2000s. Difference 3, a supportive policy backdrop. The Federal Reserve today is cutting rates, not raising them like in 2000. Difference 4, tangible infrastructure. Even if some AI companies fail, the chips, data centers, and software still hold real value. Here's the thing, a crash could happen, but it may look more like a rotation. And personally, I think governments and central banks will turn the money printers on and avoid a crash. Just my humble opinion. Section 5, how to invest calmly in any market. Before I tell you how, let me tell you some of my experience. The 2008 financial crisis had a bad effect on me, and it contributed to my negative decade between 2008 and 2018, where I didn't invest into assets, not properly, not really, and made far too many mistakes, like losing our life savings in the stock market in 2011, chasing quick, easy money. But from 2019 onwards, I've got my act together after putting the work in and focusing on financial education. Since then, I've invested every single month in a low-cost index funds for me, my wife and our daughters. Despite COVID, when markets crashed 35%, despite high inflation, despite any market pullback or correction. Anyway, here's your simple, powerful roadmap. 1. Stick to fundamentals. If you want the simple way to build wealth, you invest into a low-cost index fund. But what fund do you buy and how do you do it? If you want to find out step by step, see below for my latest playlist. If you prefer individual companies to potentially get yourself higher returns, ask yourself important questions like, is there revenue? Is there profit? Is the price justified? If not, you know what to do. 2, stay diversified. Never bet your portfolio on one sector. Not tech, not AI, not anything. I like to be globally diversified, and the fund I invest into is the Vanguard Life Strategy 100 Fund. 3, avoid herd behavior. If every headline says buy AI, pause, think independently, go against the crowd. 4, keep a long-term view. If you have the patience and discipline to invest long-term, you'll be okay from my experience, my opinion. Markets always boom and crash, but the long-term trend for equities, up and to the right. Stay the course, stay disciplined, stay invested. Summary. If this helped you stay calm and clear about what's actually happening in the markets, let me know in the comments and maybe send it to someone who needs a bit of help with their investing. And if you want deeper analysis, tools, strategies, basically more support and a community of investors who stay cool, calm and collected under the pressure of a market crash or potential crash, again check out the link in the description. Investing can be lonely if you do it by yourself, as I've found the hard way over the last 24 years. But I can give you loads of info and loads of one-to-one support in my school community. But what after all of this info, you're interested in AI, you want to invest into it, but you're not sure what to invest into? Well, if you have a little look below in the description, again, I'm getting you in the description, I'll leave the link for a recent video all about Tau Potenza, what many experts are comparing to Bitcoin 10 years ago.